Thank you, Mr. Chairman. Mr. Gupta, as we're looking at housing finance reform, one thing that we need to accomplish if we are to consider a taxpayer guarantee is to ensure that adequate private capital exists in all phases of the mortgage process. And this private capital must include a mix of borrower equity, private insurance, and investment, and adequate government reserves. How important do you consider the borrower equity to be in this context?
Thank you, Senator Crapo. Borrower equity is very important. We obviously are in the business of low down payment lending, so we take into account every single factor. But low down payment loans are not the reasons for this downturn, and they shouldn't be actually held back as we come out of this downturn and actually create the new housing reform. We look at a loan, we look at the three factors, which is credit, capacity, and collateral. So instead of just looking at a down payment, we would look across the file and see that the borrower is the right borrower. Not only can they get into the home, but they can stay in the home long term. Now, turning to Corker Warner S1217, we really applaud the usage of mortgage insurance, deep mortgage insurance in that bill. And when we think about the standard coverage, the way it works is if a borrower comes in and put 5% equity down, the mortgage insurance company, it puts additional coverage that basically creates a remote coverage for the investor. So the investor is almost covered till 65% loan to value. So the home will actually have to really incur a loss of more than 35% for the investor to take a loss, which actually removes the burden from the taxpayers and could also reduce the amount of bond insurance or bond guarantees needed.
All right, thank you. You answered the next question I was going to ask you about the role of mortgage insurance. So let me turn to you, Mr. Platt. Some people have argued that some more prescriptive servicing rules are necessary because servicers have an economic incentive to pursue foreclosures rather than loan modifications, even though in some instances the modifications might be economically more advisable. Do you think that accurately describes the servicer's economic incentives?
Thank you for your question. I do not agree with that assessment. I think servicers want to do the right thing. If they have the authority to modify and it makes sense to do so, they are willing. I do not believe that it's in their economic incentive to foreclose. I don't think that they have some nefarious plan to put money in their pockets at the expense of the borrower. And so I just completely disagree with that.
We've heard some proposals that would restrict the ability of servicers to collect collateral in the event that a borrower defaults. Can you discuss how such restrictions would impact the cost of taking out a mortgage for the average borrower?
Mortgage loans, by definition, are secured by a mortgage on the house. Unsecured loans have interest rates in high teens. Secured loans have interest rates in 3 to 5%. In large measure, but not exclusively, because of the value and the availability of the collateral. If we reach a position where it's virtually impossible or practically infeasible to realize on the collateral of the home, as horrible as that could be for the individuals involved, I think what we essentially have done is invalidate secured loans as a method of offering consumer credit here. I think the natural consequence of that will be materially higher interest rates and lesser availability of credit.
All right, thank you. And one last question, Mr. Platt. Since 2010, a number of changes in servicing rules and practices have resulted from the National Mortgage Settlement, the Interagency Consent Orders, the FHA Servicing Alignment Initiative, and then most recently the Mortgage Servicing Rules from the CFPB. Can you discuss how these developments have impacted mortgage servicing practices, and especially, I assume that they've improved, but have they improved mortgage servicing practices?
Well, first, the new regulations will not go into effect until January, and those are the first that will have common applicability across the entire industry. I do believe that both the 2011 consent orders with the federal banking agencies and 14 banks, as well as the global foreclosure settlement with 5 major banks, set a template for the way in which servicing will be done prospectively and really formed the foundation, in part, for the CFPB regulations. It's a slow process trying to implement those regulations. They focus on various things. So, for example, the OCC consent orders focused a lot on systems and personnel, whereas the global foreclosure settlements were much more micro in detail, dictating the way in which modifications and default servicing should be handled. the CFPB decided to take just as has already been mentioned, approach based more on process, that it decided that it shouldn't dictate what an owner should be required to do if a borrower were to default, but it could dictate that borrowers are treated fairly, that they're made aware of the options that may be available to them, and that they're given prompt and effective notice and access to personnel. And I think that's going to have a lasting impact on the quality of servicing.
Thank you.